In 2025, traditional portfolios aren't cutting it for high-income Canadians. So if you're earning six figures or you have a sizable chunk in investable assets, you need diversification beyond just stocks and bonds. Today, I'll walk you through how some of our wealthiest clients are allocating 20 to 40% of their portfolios into alternative investments and why we're doing it now more than ever. I'm Rob Tétrault. I'm a senior portfolio manager and branch manager here at the Tétrault Wealth Advisor Group, and we specialize in helping Canadians protect, grow, and transfer their wealth, all while doing it tax efficiently. That's the key here. Listen, we all know about the 60-40 portfolio. It's been around forever and it's been underperforming for a very long time. My dad was building this in the 70s. It hasn't worked well over the last few years. Bonds got crushed when interest rates went the other way. Equities have been volatile. Inflation eats away at purchasing power. Many of my clients now ask, what can I do differently? And that's where alternatives come in. We've been doing this for a very long time, mixing in real assets and alternative assets in portfolios as a third asset class along with stocks and bonds. Why do we do that? Well, alternative assets are less volatile than your traditional equities. They have a lower correlation with the stock market. And when properly integrated, they lower portfolio risk and improve long-term returns. And if you care about your risk-adjusted returns, these things are gonna send that number through the roof. All right, I'm gonna take you through the 5 alternative buckets that my clients use in their portfolios and how we build these portfolios for them using these different buckets inside of their alternative assets. So let's talk about the first one. You've probably heard about this one, real estate. The first bucket, we're not buying a condo in Toronto. I'm talking about institutional grade real estate pooled funds, and they're done through a private fund, and that's multifamily, industrial, and all sorts of different income generating properties across North America. Our focus is on Canada, but we do have some exposure in the US as well. These funds offer stable, tax efficient, monthly income. Some yield anywhere from 5 to 8% annually with capital appreciation layered on top. So for clients looking to preserve wealth and earn income, this is a strong choice. And how does this work? All right, you own real estate. Well, first off, there's cash flow generated. Anyone who's paying rent to use that real estate is giving cash flow, right? They're paying. The manager takes that cash flow, pays down the debt, all right? So when you get the cash flow, then you're paying down the debt. What do they do with the leftover cash flow? They distribute that to the unit holders. The unit holders receive cash flow anywhere from 5 to 8% annually. In addition, you're paying down that debt. Month by month, the mortgage is going smaller and smaller, which creates equity for you, the unit holder. And third, we hope over time, real estate appreciates in value like it has over the last 150 years. So you own that real estate, you're collecting the income, you're paying down the mortgage, and of course, hopefully, real estate appreciates in value. So you're making money in 3 different ways when you're owning that real estate. It's a great asset class to have, and it's a reason why most of our clients own a piece of real estate, alternative assets inside their portfolio. Next bucket, we got private equity. All right, private equity is for investors with longer term investment horizon. You're investing in companies that are still private, so they're not publicly traded, right? So it could be, a tech or a healthcare or an energy startup. You take a bunch of these smaller companies, you take their earnings, you put them together, and once you put them together, now you have diversified income that's a much larger number that you can then sell to a third party or go public and make a ton of money on the private equity space. The goal here is to capture capital growth. There might be a little bit of a distribution, 4, 5, 6%, but largely you're hoping to get capital appreciation in this. Next bucket, we have infrastructure, hard assets, okay? This could be energy pipelines, solar projects, data centers. Why? Why do we invest in these things? Well, they often move in the opposite direction of public equities, and they often act as a hedge. So for retirees, it's a special level of protection from market downside and inflation. So think of it this way. Let's say you invest in infrastructure, all right? Typically they're tied to very long contracts and usually with government entities. So a government entity might not want to build on their balance sheet $100 or $500 or $1 billion project. So instead, they'll use the private markets to build that project for them, and they will pay usually a very long lease, 25, 50-year leases, to use that asset. Whether it's airports or toll bridges or energy pipelines or solar projects, all of these are long-term, long asset classes, and they pay a continuous revenue stream for the owner of that asset class. consistent distributions, very stable income, and almost no volatility, these infrastructure investments can prove to be a phenomenal diversifier to public equities, and they really act as a great hedge against inflation. You get your cash flow, you know it's going to appreciate over time, and you know the asset is still going to be there and has a terminal value, which is very important when you're investing in infrastructure. Bucket 4, music royalties. You may not have heard of this one, but artists or writers will sell their catalog to cash out from the investment world. They're selling the right to their songs. Every time a song gets played, a royalty gets created and gets distributed to the owner of that song, the rights owner of that song. So what's happened over time is fund managers have started accumulating catalogs, accumulating songs by various artists. And every time those songs get played, they pay a distribution. We invest some of our clients' money along pension-style investment mandates, investing in these same music royalties. So the neat thing about music royalties is it's pretty much recession-proof in that, am I still gonna listen to songs tomorrow? Am I gonna cut my Spotify subscription tomorrow if I lose my job? Probably not. It's one of the last things that's gonna go. In fact, I might listen to more music, if things are bad in the economy. So it's very recession-proof. It provides great cash flow, and it's a growing market. Music royalties are growing every year. Why? Because as I'm seeing at home, my kids have all these devices and they're starting to stream music across all sorts of stuff, whether it's their PS5 or in the car or on their various apps. We are seeing streaming grow rather considerably in the North American market and globally over the last 10 years. We like it as an asset class because it's stable, it's consistent, it's predictable, and it's there. People are going to listen to music. People love music in a growing industry. Makes a lot of sense for someone to generate 8 to 10% returns annually with little to no correlation to the stock market. Bucket number 5, private credit. Think of this like lending money to established companies that don't quite fit into the bank's standard lending practices. Now, normally the lending rate is going to be a little bit more than the prime rate that you and I are able to get for our mortgages, but these are typically companies that need capital. Usually these companies have a very strong balance sheet, really good perspective for future income. Usually there's various levels of guarantees to it. They're great companies that the banks consider too small or unconventional. For whatever reason, the banks are passing on these, and there's a whole market that is lending to these individuals or these companies at a slightly higher rate. And we can benefit from that. It's a great space to be with low volatility, uncorrelated to the stock market, and consistent income. This is going to be classified as income, so you want to make sure that you're properly allocating these assets to the right accounts. Obviously, a corporate account, a non-registered account, and a registered account, they don't all get taxed the same way. So this might be best suited for an RSP or a LIRA or a RIF, and perhaps not a corporate account. But that's our job. We're in charge of making sure that we take care of that for you. It's nothing that you have to think about. It's what we do for clients. Now, those are the 5 kind of main buckets, but there's always other things that we're looking at, commodities, storage, crypto for some, sports teams, fine wine, art, diamonds, trading cards. These are all alternative asset classes that some really love to get into and some prefer to stay away. We like to focus on, the large buckets, the assets we understand with a lot of the liquidity, markets, funds that we can invest in. And it's been working very well for our clients. All right, so you're probably asking me, Rob, this sounds great. How much of my portfolio should I allocate to alternatives? Well, it depends. Not an answer you want to hear, but it does depend. Most of our clients have anywhere from 20 to 40% of their liquid net worth in alternative assets, in that third bucket, not stocks, not bonds, but alternatives. Now, it depends on what stage you're at in your life, your liquidity needs, depends on your income needs, depends on your appreciation for risk, obviously. All of these factors are built custom for us here for every client. So, a 55-year-old executive, approaching retirement might have a little bit more towards private real estate, private credit, and maybe some music royalties, whereby a 40-year-old entrepreneur might have much more private infrastructure, private equity, and maybe a little more growth than the retiree. So the thing is, these allocations are customized. There's no one size fits all. They need to be integrated with your tax plan. They need to be integrated with your liquidity goals, and they need to be integrated with your estate plan. And that's one of the things we do here, right? We don't let anyone invest without the right hand talking to the left hand. The planning needs to talk with the investments, all right? We want to make sure that the plan matches the investments, and we're going to meet your cash flow needs. We're going to make sure that we're tax efficient. We're going to make sure your liquidity needs are met. We got to make sure all these things are met. So we create a custom portfolio for you and for your allocation. So go to speaktorob.com to book your no obligation consultation to chat about this your asset allocation, or anything else that's on your mind. We're here for you. We've been doing this for a very long time, and this is what we do. If you're a high income earner looking to build a future-proof portfolio, alternatives, they're not just an option. I think they're essential. We also go deeper into this in our free retirement planning masterclass. The link is in the description below. I really think you should take some time and check it out because there's so much valuable information there. You owe it to yourself to check it out. Make sure to like and subscribe for more content. Thanks guys, I'll see you in the next video. Hey guys, before we finish, please remember everything shared in this video is for general information and educational purposes only. It's not personalized financial, legal, or tax or investment advice. All investments carry risk, including the potential for loss. And you know this, but past performance is not an indication of future results. Always consult a licensed professional before acting on any financial advice. And obviously, your situation is unique and your advice should be too.